It began with a single announcement from Washington, but within hours, the shockwaves crossed the northern border and hit Canada like a hammer. The U.S. Commerce Department just raised tariffs on Canadian softwood lumber from 20.56% to 35%, one of the steepest hikes in modern trade history. For decades, Canadian timber has been the quiet backbone of America's housing market, framing everything from suburban homes in Texas to skyscraper interiors in New York. But overnight, that lifeline was cut. In retaliation, Ottawa and Ontario's provincial leaders delivered a brutal counterpunch. Canada just cut the United States off from lumber. And with that, a trade dispute turned into a supply shock threatening to cripple construction across the country. The numbers are staggering. 28 million cubic meters of wood, nearly $8.5 billion worth of trade, has vanished from the American supply chain. Imagine losing the material to build one-third of all U.S. homes in a single night. For families already battling soaring inflation and record mortgage rates, this is the moment when the dream of homeownership starts to slip away. A house that once cost $250,000 could now surge by $10,000 to $30,000 just because the wood to build it no longer exists. Builders across Florida, California, and Ohio are freezing projects mid-construction, while suppliers report shelves empty and prices rewritten daily. Canada called the tariffs unjustified and protectionist, but the reaction went beyond rhetoric. Within 24 hours, lumber trucks stopped at the border, shipments canceled, contracts voided. Washington may have believed it was defending domestic industry, but the truth is brutal. America can't produce enough wood to replace what it just lost. U.S. mills only meet about 70% of national demand, leaving a 30% shortfall that has always been filled by Canada. Without that supply, the market isn't just tightening, it's collapsing. The fallout is already spreading. Lumber futures on the Chicago Mercantile Exchange spiked within hours. Developers are warning of layoffs. Banks are quietly tightening lending. What began as a tariff decision is now a political and economic grenade, one that threatens to explode across every sector tied to construction and housing. And the question rising from both sides of the border is the one no one in Washington wants to answer. Why start a trade war you can't afford to win? Because when you cut off the wood that builds a nation's homes, you don't just halt construction, you test the strength of the entire economy itself. To understand how this crisis began, we have to go back decades to the roots of one of North America's longest-running trade wars, the battle over softwood lumber. Since the early 1980s, the United States has accused Canada of unfairly subsidizing its timber industry, claiming that low stumpage fees, the prices Canadian producers pay to harvest wood from public land, amount to hidden government support. Washington has argued that this lets Canadian mills sell lumber cheaper than American producers can compete, with a charge that has reignited every few years, like a wildfire that refuses to die. But while U.S. officials call it dumping international trade panels from the World Trade Organization to NAFTA, tribunals have repeatedly sided with Canada, ruling that the evidence of wrongdoing is thin and the penalties unjustified. For decades, both sides have played this dangerous game of tariffs and countermeasures. Yet, behind the politics lies a hard truth. America doesn't have enough trees to meet its own needs. From the Rocky Mountains to the Deep South, domestic forests can only supply about 70% of national demand, leaving Canada's massive boreal reserves to fill the gap. Every year, more than 28 million cubic meters of softwood lumber, valued at over $8.5 billion, flow south across the border. That lumber builds homes, schools, hospitals. It is quite literally the framework of the American way of life. Without it, the construction industry buckles, prices soar, and the dream of home ownership drifts further out of reach. But politics rarely bows to logic. In the spring of 2025, under mounting pressure from domestic producers and political factions calling for economic sovereignty, the U.S. Commerce Department raised its tariffs again, this time to 35%. Officials framed it as a defense of American jobs, but industry insiders warned that such a move was economic self-sabotage. Tariffs may sound patriotic on paper, But when a country depends on imports for critical materials, they act more like a tax on consumers than a shield for workers. Canada's lumber producers didn't just shrug, they retaliated. Within days, Ontario, home to some of the country's largest sawmills, halted all lumber exports to the United States, describing the move as a defense of national interest and worker sovereignty. The response caught Washington off guard. The assumption had been that Canada, so dependent on U.S. markets, wouldn't dare to retaliate. But that assumption ignored a shifting global landscape. Over the past 5 years, Canada has quietly diversified its trade partners, signing new deals with Japan, South Korea, and the European Union, each hungry for reliable building materials amid global construction booms. When the U.S. raised the tariff wall, Canada simply turned its trucks east and west. The effect was instantaneous. America's housing pipeline began to dry up, while new markets opened for Canadian exporters at higher margins. At the heart of it all lies a fundamental paradox. The United States, in trying to punish Canada for unfair competition, has exposed its own dependence. Without Canadian lumber, every sector tied to construction, from hardware retailers to mortgage lenders, begins to feel the strain. Contractors in Florida pause mid-build. Families in California delay their remodels. Banks in Ohio rewrite their lending standards. The ripples turn into waves, and the waves into shock. What was meant to be an assertion of strength now looks like a self-inflicted wound. And yet this isn't just about trade, it's about pride politics and the illusion of control in an interconnected world. The lumber dispute is a mirror reflecting how fragile modern economies have become when supply chains cross borders and policies collide with reality. The question now isn't whether the United States can win this standoff. It's whether it can endure the cost of fighting it. The collapse didn't come gradually, it struck overnight. The moment Ontario shut down its lumber exports, the American market began to convulse. Within hours, lumber futures on the Chicago Mercantile Exchange spiked by double digits, and analysts warned that prices could soon breach $765 per thousand board feet, a level not seen since the post-pandemic housing frenzy. Builders in Texas, Florida, and California, states that together account for more than half of America's new housing, suddenly found their cost estimates shattered. A project that once budgeted $2 million for lumber now faced a bill of $235 million or more, wiping out profit margins and forcing developers to halt construction midstream. For the ordinary homebuyer, that translates into an extra $10,000 to $30,000 on the price of a single-family home. Multiply that across millions of buyers, and what began as a trade dispute becomes a nationwide affordability crisis. Across Florida's booming suburbs, cranes stood motionless against the skyline. In Ohio, construction crews were sent home as supply yards sat half-empty, their price tags rewritten daily. In California, where housing affordability was already a nightmare, the shortage turned critical. Contractors spoke of rationing wood, using scraps to keep essential builds alive. What had been a policy debate in Washington now felt like an emergency on Main Street. Even the National Association of Home Builders issued a rare warning: the supply cut had raised construction costs by 10 to 15% in just weeks, threatening to derail the fragile housing recovery. But the chaos didn't stop at construction sites. It spilled into finance. Banks, already jittery over rising mortgage rates, began tightening lending requirements. Smaller builders, the backbone of America's suburban expansion, couldn't secure credit to start new projects. Homebuyers watched their pre-approved loans expire before foundations were even poured. For millions of Americans, the dream of ownership was replaced by delay frustration or outright cancellation. And as prices soared, property taxes followed, squeezing retirees and first-time buyers alike. The very industry that once symbolized stability was now the epicenter of a new economic quake. The pain was not evenly spread. California and Texas, the two largest housing markets in the nation, were hit the hardest. In Texas, population growth had fueled one of the biggest building booms in U.S. history, until the lumber cut turned progress into paralysis. thousands of carpenters, framers, and truck drivers faced layoffs as developers paused projects indefinitely. In California, where the median home price already exceeds $800,000, another $15,000 to $20,000 increase could push millions out of the market completely. Economists warned that every $1,000 rise in home prices excludes roughly 150,000 potential buyers nationwide. By that math, Canada's export freeze didn't just slow construction, it priced out an entire generation. Meanwhile, the political fallout spread as fast as the economic one. Governors across the Midwest and South blasted Washington's tariff policy, calling it reckless and detached from reality. In Congress, hearings erupted over who should be blamed: trade negotiators, the Commerce Department, or the White House. But for ordinary Americans, the arguments meant little. All they saw were unfinished houses, rising rents, and paychecks that no longer stretched far enough. The lumber crisis had become personal, and it was eroding trust in the very idea that the government understood what ordinary families were going through. Beyond the numbers and policy papers, the human toll grew visible. Construction workers who once clocked steady hours found themselves jobless. Hardware stores that depended on steady lumber sales faced closure. Local governments saw tax revenues plunge as projects stalled. In Erie County, New York officials reported losses exceeding $4.9 million per month directly tied to the collapse in cross-border trade. The shock was rippling outward from border towns to boardrooms, from households to the heart of Wall Street. Real estate trusts, construction firms, and even municipal bonds linked to housing developments began to wobble under the pressure. What had started as an economic weapon against a neighbor was now threatening to destabilize the U.S. economy itself. And yet perhaps the most dangerous part of the collapse wasn't financial, it was psychological. Markets can recover, supply chains can adapt, but confidence once broken doesn't return easily. The belief that America could build its way out of crisis was fading. Each canceled project, each empty construction site was a reminder of how deeply dependent the nation had become on the very neighbor it tried to punish. The United States hadn't just lost lumber, it had lost leverage. The numbers told one story. The empty neighborhoods told another. Together they revealed a sobering truth. When a nation turns tariffs into weapons, it risks firing at itself. While the United States was reeling from the shock, Canada made its next move not in anger, but with precision. In Ontario, where some of the nation's largest sawmills hum among endless pine forests, the government announced a bold shift. If Washington wanted to weaponize trade, then Canada would weaponize supply. Instead of pleading for tariff relief, Ottawa turned the crisis into opportunity. Within days of the export freeze, provincial leaders unveiled a sweeping plan to redirect lumber shipments away from the U.S. and into markets across Asia and Europe, nations eager for stable sources of wood as global construction demand surged. What looked like retaliation was in truth strategy, a calculated pivot from dependence to dominance. The effect was immediate. Tokyo, Seoul, and Berlin began negotiating new long-term contracts, offering prices well above what American buyers once paid. For decades, Canadian exporters had relied on the U.S. to absorb nearly 70% of their output, often at lower margins due to trade disputes. Now, those same companies discovered leverage they'd never had before. If the United States wants to pay in politics, others will pay in cash, one Ontario official remarked. The numbers backed him up. Analysts estimated that if Canada reallocated even 25% of its U.S.-bound lumber to overseas buyers, total export revenue could climb by $2 to $3 billion annually, even with reduced volume. For Ontario's forestry sector, this wasn't a crisis, it was evolution. But the transformation didn't stop at rerouting trade. Canada began rethinking what it exported altogether. Instead of shipping raw softwood mills, pivoted to producing engineered timber modular housing units and finished cabinetry products with profit margins 2 to 3 times higher. The policy echoed a lesson learned years earlier during the oil downturn. When raw materials lose value, processed goods sustain nations. By focusing on value-added exports, Canada could insulate itself from future tariff wars, while creating thousands of skilled jobs at home. In the words of Ontario's Minister of Economic Development, why sell logs cheap to a neighbor who punishes you when you can sell homes and furniture to partners who respect you? The global reception validated that logic. In Japan and South Korea, construction firms desperate to diversify away from unstable supply chains welcomed Canadian partnerships. European builders facing record material costs from regional shortages saw Canadian wood as a lifeline. The shift redrew the trade map. Overnight shipping routes, once dominated by U.S.-bound trucks, were now filling with freighters departing from Vancouver and Halifax, their cargo bound for Rotterdam, Hamburg, and Yokohama. The site sent a clear message: Canada no longer needed America to thrive. In Washington, the realization landed like a second blow. By escalating tariffs, the U.S. had not only triggered a supply crisis, but accelerated its neighbors' rise. Economists called it reverse leverage, a policy meant to punish a partner that ended up empowering them instead. The American construction sector, once cushioned by cheap Canadian imports, now faced global competition for what little supply remained. Prices continued to climb, while Canada's economy began to rebound through diversification. The irony was unmistakable. The U.S. was paying for Canada's modernization. Meanwhile, at the border, the silence grew deafening. Crossings that once carried steady convoys of lumber trucks now stood half-empty. The Peace Bridge in Buffalo, the Ambassador Bridge in Detroit, and the crossings near Niagara Falls all saw trade traffic plunge by double digits. Towns built on cross-border commerce from Erie County to Windsor felt the financial chill first. Yet on the Canadian side, the narrative shifted. In newspapers and parliament halls, the move was cast not as aggression, but as sovereignty. For too long, said one editorial in the Toronto Star, we sold our forests to build their homes. Now, we're building our future. The psychological turning point was clear. What had once been a defensive economy forever reacting to Washington's policies was now setting the terms of engagement. The lumber war wasn't just about trade anymore. It was about identity: who controlled the resources that shaped North America's future. And in that contest, Canada had just rewritten the rules. By the time Washington grasped the full scope of the shift, it was too late. Lumber prices were still rising. Canadian exports were finding new homes overseas, and public frustration in the U.S. was boiling over. Every unfinished house, every delayed mortgage, every news headline about rising costs became proof of a government trapped in its own making. The neighbor America once saw as dependent had just become indispensable. By the time the shock settled, the ripple had already begun to spread far beyond the border. What started as a tariff fight between Washington and Ottawa was now infecting the arteries of global trade. The U.S.-Canada lumber war had morphed into something far more dangerous, a contagion creeping into shipping lanes, commodity markets, and the fragile confidence of investors worldwide. In the weeks following Ontario's export freeze, cross-border traffic collapsed. At the Rainbow Bridge near Niagara Falls, freight shipments fell by 33%. At the Peace Bridge in Buffalo, trade volumes dropped another 12%. Those weren't abstract figures, they were trucks, parked idle warehouses shuttered, and border towns watching lifelines dry up. In Erie County, New York, officials estimated tax losses of more than $4.9 million every month. Money once funding schools, roads, and hospitals now vanished into the vacuum of a policy war. But the tremors didn't stop there. As Canada shifted its lumber toward Asia and Europe, American builders turned outward in desperation, bidding against global competitors for scarce wood. Germany could offer barely 2 million cubic meters a year. Sweden, another 1 million. Chile, slightly more. Together, not even a fifth of what Canada once supplied. Each contract signed overseas tightened the global market further. Prices of structural timber surged across Europe, sending builders in London, Paris, and Warsaw into crisis. In Asia, developers scrambled to secure long-term deals before U.S. buyers could outbid them. When America enters the market, one Korean importer said everyone else pays more. The lumber shortage was no longer regional, it was planetary. Meanwhile, inside the United States, the ripple became a wave. the construction sector, responsible for nearly 4% of U.S. GDP, began to stall. Delays cascaded from housing to infrastructure. Highway projects, public schools, and municipal buildings suddenly cost 10 and 20% more to complete. Inflation metrics began to climb again, putting pressure on the Federal Reserve, which faced a nightmare scenario, a new cost shock layered atop an already fragile economy. Analysts on Wall Street warned that the lumber squeeze could bleed into broader inflation, forcing rate hikes that would push mortgage costs even higher. Homebuilder stocks plunged, real estate trusts wobbled, and municipal bonds tied to development projects began to look toxic. The very tool meant to protect American industry had become a wrecking ball, swinging through the financial system. At the diplomatic level, the mood grew colder. European trade ministers cautioned that if the U.S. could weaponize tariffs against one of its closest allies, then no partnership was safe. Asian economies, flush with capital and resources, saw an opening to fill the void Canada left in American supply chains. Deals for Brazilian soy, Vietnamese textiles, and Indian pharmaceuticals accelerated as nations began realigning their trade priorities away from the United States. What had been a bilateral dispute was now redrawing the global economic map, and Washington found itself increasingly isolated in the game it had started. Inside Canada, confidence swelled. Exporters celebrated record contracts with Tokyo and Seoul, while European demand pushed prices to historic highs. Economists in Toronto called it a quiet decoupling, one that finally freed Canada from decades of dependence on U.S. consumption. For the first time in generations, the power dynamic across North America had shifted. The world was watching a smaller neighbor outmaneuver a superpower not through force, but through leverage. By early autumn, the numbers painted a sobering picture. U.S. home completions were down 18%. Mortgage rates had crept past 8%, and average construction costs were up nearly 25% year over year. Supply yards in Texas, Ohio, and Georgia stood half empty, while freighters carrying Canadian lumber sailed east across the Atlantic. Every headline, every market chart, every stalled project told the same story. The ripple had become a current, and it was pulling the world economy in a direction few had prepared for. The lesson was clear. In a world bound by supply chains and shared dependence, even a single cut can bleed across continents. The U.S.-Canada lumber war was no longer just about trade. It was a warning that economic sovereignty in the 21st century might be nothing more than an illusion. By the time the dust settled, the United States was staring into a mirror it didn't want to face. For decades, America had built its homes, its towns, and its prosperity on a foundation quietly supplied by its northern neighbor. Canadian lumber wasn't just a commodity, it was the unseen framework of the American dream. But when Washington pulled the tariff trigger, it discovered that economic power means nothing when you depend on what you punish. Even at full capacity, U.S. mills can meet only about 70% of national demand, leaving a gap so wide that no quick fix exists. Germany, Sweden, and Chile combined can't replace Canada's 28 million cubic meters a year. Those numbers aren't negotiable, they're a reality check on the limits of self-reliance. The fallout continues to ripple through every corner of the economy. Builders are still paying premiums. Mortgage rates remain high. Homebuyers in Texas, California, and Florida are watching the goalposts move further away. Each week, more projects freeze mid-build, and every unfinished frame stands as a symbol of policy arrogance. What was meant to protect American jobs has become an inflationary time bomb detonating in the heart of the housing market. And while the U.S. scrambles to stabilize, Canada is rising. In Ontario, the very province that cut America off production lines hum with renewed purpose. The lumber that once crossed the border is now being transformed into engineered wood, prefabricated housing, and high-value exports bound for Asia and Europe. The policy that was supposed to punish Canada has instead accelerated its modernization. Economists in Toronto estimate that the pivot could generate $2 to $3 billion in additional annual revenue, creating thousands of skilled jobs and reshaping the national economy. The irony cuts deep. The U.S. tariffs are funding Canada's transformation. Beyond economics, something deeper has shifted. The longest undefended border in the world now feels like a fault line. Trust between the two nations, once the cornerstone of North American stability, has cracked. And with it comes a chilling question: if Washington can't manage peace with its closest ally, how will it handle rivals waiting for their chance to strike? The world is watching, and not just for lumber. From oil to microchips, from steel to food, nations are learning how supply can become leverage and how quickly a superpower can stumble when it forgets that interdependence is its greatest vulnerability. So now, America stands at a crossroads. It can cling to the illusion of control, doubling down on protectionism that isolates it further. Or it can confront the truth that in a globalized world, power no longer belongs to the biggest economy, but to the one that controls the supply. Canada understood that. Washington didn't. The question now is whether the United States will adapt before another lifeline gets cut. Because this isn't just about wood, it's about what a nation is built on. And when the materials run out, the cracks don't stay in the walls, they spread to the foundation.